In 1991, India faced a severe balance of payments crisis. Its foreign exchange reserves had dwindled to a point where they could cover only 2 to 3 weeks of essential imports. The economic shock of the Gulf War and the disintegration of the Soviet Union were some of the factors that had led to this crisis. To avoid defaulting on its debt, India approached the International Monetary Fund, or the IMF. But the IMF imposed a condition. India had to implement sweeping structural economic reforms in order to receive the IMF loans package. Welcome to The Why in History. I am Ajay Kaul, and today we take a look at the economic liberalization of India in 1991 and its path towards becoming an economic superpower. Post India's independence in 1947, India's economic history can be divided into two distinct phases. The first phase was from 1947 to 1991 and was characterized by a mixed economy model, which was often called the license Raj. Both the public sector and the private sector existed side by side, and this was a system of strict government control and regulation and was intended to protect the Indian industry, promote self-reliance, and ensure regional convergence. So who conceived and drafted this policy? The standard answer provided is India's first Prime Minister Nehru and his political party, the Indian National Congress. But this is not accurate. India's economic policy post-independence was influenced by the Bombay Plan of 1944. Several prominent Indian industrialists at that time got together to draft a policy document for the Indian economy, and this came to be known as the Bombay Plan of 1944. The industrialists who contributed to this document included G.D. Birla, J.R.D. Tata, Sir Ardeshir Dalal, Shriram, Kasturbhai Lalbhai, A.D. Shroff, and John Mathai. At the core of this document was the improvement of lives and well-being of the general Indian populace. Now, one thing to note is that as India was approaching getting independence from the British, it was hopelessly poor, primarily because of steady deindustrialization by Britain. In 1700, prior to the British era, India's share of world income was 22.6%, almost equal to that of Europe. In 1952, post-independence, it was a mere 3.8%. As former Prime Minister Manmohan Singh once said, the brightest jewel in the British crown was the poorest country in the world in terms of per capita income at the beginning of the 20th century. So with this backdrop, the doyens of Indian industry at that time got together in Bombay to draft India's economic policy document. The document proposed a planned economic development to improve the standard of living of the masses, reduce disparities of income and inequalities, and make India self-sufficient. The document proposed nationalization of a few industries and public supervision and control of industries which were affected with a public interest or capable of wielding monopoly power. Whoa, wait. The doyens of Indian industry at that time that had overcome so many odds to become top industrialists under the British rule were advocating for a state control of the Indian economy? Yes, and this was primarily because the wounds of the Great Depression were still very fresh. And these industrialists felt that unrestricted private enterprises could cause another depression, and India's poor population would not be able to sustain it. They also noted that private enterprise and ownership had failed to bring about a satisfactory distribution of national income. So it was important for the state to control private enterprises, to check monopolies, profiteering, misuse of scarce natural resources, all of which could have a huge impact on future generations. There was another reason, though, for recommending state ownership of the overall economy, and that was the realization that only the state could mobilize huge financial resources and funds needed to develop some basic industries which were critical for the social and economic development of the country as a whole. So India took a lot of recommendations from the Bombay Plan to implement its economic policy in the first few decades post-independence. Post-independence, India was very focused on self-reliance. The 200 years of British colonialism had taught a lot of important lessons to the public as well as the politicians. So they were very particular about not relying too much on foreign investment and ending up being economically colonized, which meant imports needed to be restricted, which meant India needed to put a lot of investment in building its own heavy industry. And inspired by Soviet Union's rapid industrialization in the early part of the 20th century, India took a leaf out of Stalin's execution playbook and implemented the 5-year plans. The Planning Commission was set up in 1950 to oversee the entire range of planning, including resource allocation, implementation, and appraisal of the 5-year plans. The first 5-year plan was launched in 1951 and focused on agriculture and irrigation to boost farm output to reduce food grain imports. Overall, the plan was a success, with the economy growing at 3.6% annually, beating the target of 2.1%. The second 5-year plan, though, from 1956 to 61, laid the foundation for the economic modernization of India. The architect of this plan was the founder of the Indian Statistical Institute, Prashanta Chandra Mahalanobis. Cementing the target of self-reliance, the plan targeted rapid industrialization with a focus on heavy industries and capital goods. The plan categorized industries into 3 groups: industries of basic and strategic importance, which were to be exclusively in the public sector or state-owned. The second group comprised industries that were to be incrementally state-owned, while the third comprised mostly consumer industries and were left for the private sector. Now, the second 5-year plan accomplished massive milestones with respect to India's industrialization. Steel mills were set up in the towns of Bhilai, Durgapur, and Rourkela. The coal output was increased and new railway lines were laid out. The Atomic Energy Commission, which set the path for India's nuclearization, was created in 1957 and led by Dr. Homi Bhabha. The Tata Institute of Fundamental Research, to promote scientific research, was established. And most important of all, India's premier institutes of technology, the IITs, were set up in the cities of Bombay, Kanpur, Madras, and New Delhi. India's first IIT, though, was set up in 1951 in Kharagpur as part of the first 5-year plan. Now, all this is very important because contrary to Mao's China, Nehru's India laid the groundwork for higher education of the masses, notably technical and scientific education. And this led to the emergence of a robust, educated middle class. And this would end up being India's biggest competitive advantage when it opened up its economy in 1991. Overall, the second 5-year plan was successful in achieving its targets, though it missed its overall growth rate target of 4.5%, the actual being 4.27%. It was successful in creating industrial jobs, and the overall per capita income rose by 8%. With industrial growth and output being the focus during the second 5-year plan, agriculture took a hit. In fact, agricultural production barely kept pace with the population growth. So India's food security remained precarious, and this was glaringly obvious when the country experienced a food crisis in the mid 1960s, with the new Prime Minister Lal Bahadur Shastri at the helm. As a result, India had to import significant amounts of subsidized food grains, primarily wheat, from the United States. Since this food aid was crucial towards averting famine and starvation in the country, Indian economy was given a new nickname, ship-to-mouth economy. And this aid of food grains benefited both the United States and India, because for the United States, it helped dispose of the agricultural surplus within the country, but it allowed India to purchase these food grains using Indian currency rather than the US dollar. And the currency accumulated was then pumped back into India to fund economic development projects. And with this economic strife, it was generally believed that India would start liberalizing the economy. But help came from a very different quarter. The man who fed the world, Dr. Norman Borlaug, had just discovered high-yield varieties of wheat. And in partnership with Indian scientist Dr. M.S. Swaminathan, the high-yield varieties of wheat were introduced in India, and slowly this triggered what came to be known as the Green Revolution. The Green Revolution ushered Indian agriculture into the modern era through high-yield varieties of crops and modern tools and implements. And by the 1970s, India was a net exporter of these food grains, specifically rice and wheat. But all this would not have been possible without an increased budgetary support for the agricultural sector. And if the newly appointed Prime Minister Indira Gandhi had maintained status quo, the budgetary support increase to the agricultural sector would not have happened. In 1966, when Indira Gandhi came to power, India had been through a war with Pakistan and also just avoided famine and starvation. There was a severe balance of payment crisis, and a condition was imposed by the United States and the World Bank to resume foreign aid: the devaluation of the Indian rupee. So in June of 1966, the Indian government devalued the rupee by 57%, and this made Indian exports cheaper, improving the balance of payments. But the key question still remained: how to finance the agricultural sector adequately to boost agricultural production. Since the 1950s, most of Indian banks were controlled and owned by the private sector, notably the large corporate houses. In many cases, the promoters of these corporates and banks were directors of multiple other companies as well, and they often sanctioned and provided loans to these companies, which would create a conflict of interest. And agriculture was not a sector of interest for these financial institutions. And to solve this problem, in July of 1969, 14 banks, which controlled 85% of the total deposits, were nationalized. And these included Bank of Baroda, Punjab National Bank, and Indian Overseas Bank. Now, this move was deemed draconian by the economists, but it turned out to be very popular with the masses. The newly nationalized banks were made to open branches in rural areas, which led to a massive jump in financial savings and also a big boost to farm credit and lending to other priority sectors. This was followed by the Industrial Licensing Act of 1970, which required private industries exceeding a certain asset limit to obtain licenses to continue their operations. And this period from 1970 to 1991 came to be known as the License Raj. The number of licenses required by each private enterprise were multiple, from importing supplies to exporting products, and this ultimately became a drain on day-to-day operations. There was rivalry among companies to gain licenses, and that became a breeding ground for corruption and intermixing of politics and business affairs. And the Industrial Licensing Act of 1970 was followed by the Foreign Exchange Regulation Act, or FERA, in 1973, which required multinational investors to dilute their shares in their Indian subsidiaries to 40%. So it seemed very clear that Prime Minister Indira Gandhi was against private enterprise. And gradually, the Nehru era, which tried to strike a balance between a socialist and a capitalist state of the economy, was replaced by the Indira era, which clearly favored a socialist state of economy. But there was a bigger reason behind this shift than just trying to promote agriculture and influence the financial investments. The general elections of 1967 dealt a big blow to Indira Gandhi's Congress party, reducing her majority in parliament by almost 100 seats. And Indira Gandhi seemed to have concluded that one way to consolidate her power and authority over the country was to curb and curtail private businessmen. They could not get too rich or too powerful. And that also seemed to be the reason why, in 1971, Indira Gandhi's government abolished the privy purses and other privileges of former princely states. The princes from these states were enjoying tax-free payments and other privileges from the Indian treasury, and Indira Gandhi felt that they needed to be cut to size. And the justification given by the government was to reduce government's financial burden and reduce the wealth gap between the rich and the poor. And once again, it proved to be very popular. The interesting piece, though, is even though the private sector was cut to size, the return on investment was a lot higher from private enterprises than from the public sector ones. During the 10-year period from 1976-77 to 1986-87, public sector enterprises provided an average return on investment between 3 to 5%, whereas the private enterprises returned between 17 to 23%. Overall, the Indian economy continued to grow, but at a very modest rate. Between 1970 and 1990, it grew roughly between 4.4 to 4.5%. And this came to be termed as the Hindu rate of growth. Steady, but marginal. And that brings us to 1991, when the Indian economy suddenly was engulfed in a massive crisis. India's foreign exchange reserves had depleted to a level that could cover only 3 weeks of imports. The external debt was now 23% of the GDP. Inflation was in double digits, and global banks had refused to lend further. India was teetering on the brink of bankruptcy. So what factors led to this sudden economic crisis? For years prior, India had been running a high fiscal deficit. That is, the government had been spending a lot more than the revenues it was getting. So the economy was already heading towards a disaster, but there were 3 key developments on the global front that speeded this up. The first was the 1990-91 Gulf War, which caused a sharp increase in oil prices, which led to a massive increase in India's import bill. The second was the collapse of the Soviet Union. India had relied on trade with the Soviet Union, often on a rupee exchange basis, and its dissolution created a massive disruption in trade and financing. And the third was the political instability, which had led to a downgrade of India's credit rating, which led to a significant loss of confidence among investors. In fact, when the Indian officials were in DC negotiating with the IMF for a loan, they were asked which government they were representing. Because just a few hours ago, Indian Prime Minister Chandrasekhar's government had been toppled after the Congress party had withdrawn its support. Fresh elections were called, but the political instability got worse when the frontrunner and Congress candidate Rajiv Gandhi was assassinated in May 1991 during an election rally. But by June 1991, with the economic crisis getting worse, India had a new Prime Minister, P.V. Narasimha Rao. And how serious the economic crisis was became very evident to all Indians when they saw an economist, Dr. Manmohan Singh, being sworn in as India's new finance minister. And the immediate action by the new finance ministry to boost India's foreign exchange reserves and prevent a potential sovereign debt default was to ship 47 tons of gold to the Bank of England in London as collateral to secure a much needed loan. This was a drastic move, very unpopular with the general public, but desperate times called for some tough measures. So, with the short term crisis averted, India now looked to reshape its economic policy for the long term. And Manmohan Singh summarized the new economic policy as LPG: Liberalization, Privatization, and Globalization. Liberalization meant dismantling of the license Raj and allowing market forces to play a greater role. And the key steps under this were the reduction of corporate taxes, relaxation of foreign exchange regulations, and greater autonomy for India's Federal Reserve, that is the Reserve Bank of India. Privatization entailed reducing the dominance of the public sector and encouraging private sector to participate and contribute more in the Indian economy. And this was to be achieved through disinvestment of government stakes in the public sector, encouragement of private investment in sectors previously reserved for the public sector, and greater autonomy to profit-making public sector enterprises. And globalization entailed integrating the Indian economy with the global market through steps that included reduction in import tariffs to encourage international trade, removal of restrictions on foreign direct investment, which would allow multinational companies to invest in India, and integration with international financial institutions such as the World Trade Organization or WTO. And Manmohan Singh concluded his budget speech in July of 1991 in the Indian Parliament with the following quote: "I do not minimize the difficulties that lie ahead on this long and arduous journey on which we have embarked. But as Victor Hugo once said, no power on earth can stop an idea whose time has come. I suggest to this august House that the emergence of India as a major economic power in the world happens to be one such idea. Let the whole world hear it loud and clear. India is now wide awake. We shall prevail and we shall overcome." His words did prove prophetic, and Indian economy started registering 7% plus growth rates. Foreign direct investments, which were in the 100 million range prior to 1991, started getting into billions of dollars. But one of the biggest success stories post-1991 reforms was the exponential growth of India's IT and services sector. Indian IT companies such as Infosys, TCS, and Wipro expanded globally, making India a global hub for software services and outsourcing. The services sector now contributes over 50% to India's GDP. Prior to the reforms, the public telecom monopoly had installed 5 million landlines in the entire country, and there was a 7-year waiting list to get a new line. In 2004, private cellular companies were signing up new customers at the rate of 5 million per month. Though post-1991, India continued to stay on a consistent 5% plus GDP growth rate trajectory, it is important to acknowledge the robust growth that India achieved when Manmohan Singh himself was Prime Minister between 2004 and 2014. In 2005, India was the 10th largest economy in the world, but by 2011, it had moved to the third spot, surpassing Japan. And what was remarkable was that in 2008, during the global financial meltdown, India still registered a 3% growth. Though there was some political pushback as the reforms started kicking in, the general public overall welcomed the reforms as the results started appearing. The only resistance, though, came from a very unexpected quarter, The Bombay Club, which was a group of Indian private businessmen who had achieved near monopoly status during the License Raj. This group, which comprised industrialists like Chandrakant K. Birla, L.M. Thapar, Jamshed Godrej, was led by none other than Rahul Bajaj. They were concerned about losing to foreign competition, so they suggested that reforms be implemented domestically first before opening up the economy to foreign competition. In November of 1993, this group met with Finance Minister Manmohan Singh and presented a 13-point memorandum of demands. They were given the due hearing and were asked not to share this with the general public. And on that note, we end this section of the program. On to the quiz section. Question from the previous episode. Which of the options is true about Nepal? Lumbini in Nepal is the birthplace of the Buddha, and Nepal is the only country in the world with a triangular flag featuring two stacked triangles symbolizing the Himalayas. So the answers are A and C. Nepal is the birthplace of the Buddha, and Nepal is the only country in the world with a triangular national flag. Question for the current episode. During the License Raj era, the officials of which multinational medical brand were once summoned by the government of India for overshooting their authorized production capacity during a peak flu season? Was it A. Pfizer's Crocin, B. GlaxoSmithKline's Actifed, C. P&G's Vicks VapoRub, or D. Lambert Pharmaceuticals' Waterberries compound? Once again, during the era of the License Raj, the officials of which multinational medical brand were once summoned by the government of India for overshooting their authorized production capacity during a peak flu season? Was it A. Pfizer's Crocin, B. GlaxoSmithKline's Actifed, C. P&G's Vicks VapoRub, or D. Lambert Pharmaceuticals' Waterberries compound? The answer will be provided in the next episode. That's all we have in the current episode. We meet again in 2 weeks with another interesting and exciting episode on world history. Till then, stay safe and keep exploring the why in history.